All right, so finally we get to look at an actual activity. So this is the first recording of bonds that we have purchased, and in the problem we are given the issue price of $885,301. We're giving this paid semi-annually, and the market rate was 12%. And at the original paragraph says the intent was to hold the bonds until they mature. So again, number 1 says we're taking the view of the investor. So it's going to be similar to something we did in Chapter 14, but it's the opposite because now we're investor instead of the issuer. So what would be that entry for to record that initial investment, which I'm just going to put down here at the bottom for number 1. Well, we're going to have a bond investment, or we could call it investment in bonds. You know, you can call it whatever you want to, as long as you tell me that it makes assets go up and it has the word bond in there somewhere. All right, so those bond investment, we're going to record that at face amount, similar to how we recorded bonds payable at face amount. We had to pay cash. The problem tells us we had to pay $885,301. Okay, so the difference is going to go to a discount account, which we saw in Chapter 14 when we were issuing bonds, and now this is a discount on bond investment. So when we do that, calculate the value there, it's $114,699, the difference. What's the classification? Well, the first classification is held to maturity, right? Because the management said they want to hold those bonds to maturity. All right, so this is what the entry looks like. We talked in class about the fact that this discount account is attached to the bond investment account, essentially, so it's going to make the bond investment account smaller. You're always going to put those together for the balance sheet. If the number 3, at the time of the purchase, the CFO did not intend to actively trade them, but did not intend to hold a maturity, what would that classification be? So you would say, oh, that sounds like available for sale. And available for sale security. And number 4, they're waiting for the price to get to a point they want. They intend to actively trade them. That is trading security. Okay, and then your answer for number 5. Did the entry change? No. The entry would stay the same. Okay, so again, getting back to that idea that it's there's an economic instrument, regardless of how we categorize it or classify it between these 3 choices, we would do the recording the same. Initially, we paid this amount of cash. This is the face amount. Here's the discount. All right, so now in the evening class, we talked a little questions about how that discount gets treated. It's going to be with the assets. And then we talked about, do you have to continue to do the amortization table for all of the categories? And the answer is overwhelmingly yes. You have to keep doing investment income and amortization using the effective interest method for every category. All right, so then we talked about subsequent measurement of those same bonds. If you're in the day class now, you're like, oh wait, we didn't do that immediately following. You're right, this is 2 days smashed together. Okay, we made this entry, just the last slide, we showed the original entry. What I ask you to do for this first thing is to prepare an amortization table, which you should remember how to do. I would expect you to be able to do that, to come up with the interest income entries and the amortization of the discount entries. And then we have a couple of questions. What amount's the balance sheet going to report for this investment? So you should work on an amortization table. I'm going to show you what mine looks like. All right, so there's my amortization table. Yours should come out looking like that. Should be able to do that, right? I used the stated rate of 10% semi-annual, so that's how I got the cash amount. I used the market rate at semi-annual, so I cut that 12% in half to get the revenue piece. The amortization of the discount is the difference, and there's what's happening to my carrying value. So if these bonds were bought on the beginning of the year, January, it would take a whole year. This would be 2 interest payments to get to the end of the year. So question 1, ask for an entry for the interest income. So I'm going to just do the entry real quick for the interest income. Now you know you're getting cash every time because that's why we make these investments. Okay, so we can get some cash. Okay, it might not be the primary reason, but it's going to definitely happen. All right, and we're going to have some discount amortization. Remember what happens over the life of that bond? It's going to get closer and closer, and eventually it will equal a million. Sorry, that's the face amount. Oops. I must make that be an asset. And this is my interest income. $53,118. Just came off of my amortization table. You guys know how to do entries like that. Just if you wanted to see, we'd have the same entry written for the second interest payment. It'd be a debit to cash. It'd be a debit to discount, and it would be a credit to interest income, so on and so forth. Okay, there's 2 entries. All right, so the second question asks you what amounts can be on the balance sheet for this investment. This is pretty easy because you have an amortization table, so you would go, oh yeah, I remember. If I have an amortization table, I just look at the amortization table and I say, oh, there's the value right there, $891,724. If it's a held to maturity security, then that balance sheet is going to show the amortized cost, which is $891,724. That's the amortized cost. I also ask you about the income statement impact. And the income statement impact for this held to maturity bond, you would wisely look here and say, oh, I got revenue. That probably made my income higher. And you'd say, yeah. I would say, yes. It made your income higher. Okay, if I add those 2 pieces together, my net income went up by $106,423. Question 3 says it's now an available for sale. Okay, so now we're looking at an available for sale. What amount should the balance sheet show if the fair value is $892 and it's an available for sale security? Well, you don't really need to calculate anything. You just know from what we spent all that time looking at that, building that little flow chart, or building that little chart, that it's going to be the fair value, right? Fair value here. That's what's going to get reported. And then the question says, what is the adjusting entry number 4 to actually make that happen? Let me move everything up. There goes my little craziness. Not going to all go together, which is crazy. How it decides which things are connected and which things aren't. But for entry 4, we needed to do an entry to recognize the difference between the amortized cost and the fair value. So before I even fill any numbers, I know what the amount is. It's $276. But we're going to use an account called fair value adjustment. Probably would call it fair value adjustment for available for sale bonds. That's the only category available for sale is a debt security for $276. And then I need a credit, so I'm going to use this unrealized gain or loss account. Makes average equity go up. I would put my little OCI there to remind myself. It's going to go, make sure it got into the general ledger account that goes into OCI. And that would be how I make it happen. Take the amortized cost of $891,724 and add $276 with the fair value adjustment account, and I end up with the $892. Okay, and number 5 asks you what would happen. What would happen if we had a trading security instead? And if it was a trading security, it would be the same as number 4, but, okay, here's the exception, net income, not OCI. Okay, so the only thing that would change if it was a trading security is this line of the entry. Instead of OCI, it would say net income. All right, that leaves us with number 6. What 3 general ledger accounts are going to be added to get to that fair value? Well, to answer this question, you need to think about what general ledger accounts do we have impacted by this bond investment. And if you were to record this in your general ledger, you would have had an account for one of my places on my iPad that doesn't work anymore. You would have an account for the bond, right? You'd have that asset account that would have the face amount there. You'd have an account for the discount, which has a credit balance, and now you would have an account for the fair value adjustment. Okay, so those 3 things. Those 3 accounts would go together to equal fair value. You have to put them all 3 together, the bond account, the discount account, and the fair value adjustment account. So it would be the bond account minus the discount on bond plus the fair value adjustment. All that together is going to give you the fair value. Very good. All right, so that takes care of the bonds. Now we're going to look at the equity investments. Those questions. Blah, blah, blah. Which 3 accounts? These are balance sheet accounts right there.